So, what if the very foundation of your retirement savings, the plan you rely on, was about to change in a really fundamental way? We're diving into something that could genuinely redefine how millions of Americans prepare for their future. Today, our deep dive is all about President Donald Trump's executive order. It was signed very recently, August 7th, 2025. And this order, well, it could open the floodgates for what they call alternative assets and cryptocurrencies, specifically Bitcoin, private equity, maybe even real estate, getting into your 401k plan.
And just to give you a sense of the scale here, I mean, it's truly immense. We're talking about roughly $12.5 trillion sitting in defined contribution plans across the U.S. and 401ks.
It really is, and this isn't just some minor tweak to the rules. It introduces completely new dynamics, significant opportunities for growth, yes, but also, and this is crucial, some very considerable risks. So our goal today is to cut through the noise, dig into the details, and really try to understand what this might mean for you, the individual investor, and your long-term financial planning.
Okay, let's unpack that then. Where do we even start with an executive order that feels this significant?
Well, the core of it,
Like you said, signed August 7th, specifically tells the Department of Labor, the DOL, and the Securities and Exchange Commission, the SEC, go back and look at the existing regulations, specifically.
mostly stocks, bonds, mutual funds.
Yeah, the traditional stuff.
Exactly, and that's largely been because of concerns about, well, fiduciary risks for the people running the plans, the volatility you get with alternatives, and sometimes just a lack of transparency. This order directly challenges that status quo.
It definitely feels like it fits into a broader pattern we've seen from the Trump administration regarding digital assets, doesn't it? I'm thinking back to the Genius Act signed just last month, July 2025.
Yeah.
That set up a regulatory framework just for stablecoins.
Absolutely. You're spot on. This isn't happening in a vacuum. It seems like part of a concerted push to position the U.S. as a leader in the digital asset space, at least as the administration.
It's actually a pretty huge deal for digital assets. Just the idea of cryptocurrencies like Bitcoin, maybe Ethereum, sitting inside 401k plans, that marks a massive step toward mainstream acceptance in the U.S. financial system. It's like a formal nod from the government, saying this asset class, which many dismissed as fringe not long ago, is now being considered right alongside traditional retirement investments. That's a big shift in thinking.
And did the market react? Did we see anything happen right away?
Oh, definitely. Bitcoin's price, it jumped about
1% almost immediately after the announcement, went past $117,500. So that's a pretty clear signal of market enthusiasm, right? Shows how seriously people are taking this potential change.
Well, first, you'd expect increased adoption. Potentially millions of everyday investors, people who couldn't easily put crypto in their retirement accounts before, may now have access. Then there's a potential boost for companies already in the crypto game. Think BlackRock, Fidelity. They're already involved with crypto products.
Right, they have the ETFs and things.
Exactly. They could benefit hugely by offering specific crypto funds within these 401k plans. It's a massive new market for them. And, for proponents of crypto, this
Really bolsters their argument about diversification, about potentially higher returns. I mean, look at Bitcoin. It's actually outperformed the NASDAQ index in 5 of the last 6 years in terms of.
Well, for the individual investor, the biggest thing is probably access. It could open doors to assets like private equity, like crypto, that were historically pretty exclusive, mainly for big institutions or very wealthy individuals. And yes, the potential for higher returns is there. Cryptocurrencies have shown some really impressive performance, at least during certain periods. If managed well, that could potentially boost retirement savings.
And it's not like this is completely new territory for all long-term investors, is it? I mean, big players like
Pension funds, university endowments, they've been putting money into alternative assets for years, often successfully. You could argue this is just bringing 401ks up to speed.
Criticisms. What are the major red flags here?
Absolutely critical to look at the downsides, and the most obvious one, the one everyone talks about, is volatility. Extreme price swings. Bitcoin, for instance, has had some enormous drops. We've all seen the charts. Putting assets like that into retirement accounts, that can be really dangerous, especially for people closer to retirement or those who just can't stomach that kind of risk. Then there's a transparency issue. Compared to, say, a publicly traded stock, many alternative investments have fewer reporting requirements. It can be much harder for an average person
To figure out the true value and maybe more importantly, the true level of risk they're taking on.
And what about the people running these 401k plans, the administrators? There's a huge responsibility.
That really brings up a crucial point. Financial literacy. How much does the average person with a 401k really understand about complex investments? Many folks struggle even with basic financial concepts. Throwing crypto or private equity into the mix. Could that lead to people making really bad decisions because they just don't understand what they're buying?
That's a huge concern. Financial education is absolutely key here. And another thing, costs. We can't ignore the fees. Crypto investment products,
Private equity funds, they often come with higher management fees than your standard index fund or mutual fund.
Right.
And over decades, those higher fees can really eat away at your...
he's definitely raised those concerns. And you have political figures too. Senator Elizabeth Warren, for instance, has been quite vocal. She's highlighted worries about the security of these assets and retirement accounts, the lack of robust investor protections, and again, those potentially high management fees. It's a real worry from a consumer protection angle.
So, okay, it's clear there are strong arguments on both sides. But this isn't happening tomorrow, right? The executive order starts a process. What actually happens next?
That's right. It's not immediate implementation. The order basically kicks off a review process. It gives the DOL and the SEC 180 days to examine the existing regulations. So what that likely involves is first a review of the fiduciary guidance, clarifying exactly what plan administrators need to do if they offer these assets. Second, there will have to be a lot of interagency coordination. The DOL working closely with the Treasury Department, with the SEC, to figure out what regulatory changes are actually needed.
And third, a key part of the order seems to be trying to reduce the legal risk for plan administrators. They want to make fiduciaries feel more comfortable offering these options, maybe by providing some clearer, safe...
Yes, those actions definitely seem to reinforce this broader goal the administration has stated, trying to make the U.S. a, quote, global leader in digital assets. This executive order fits right into that narrative.
So let's try to pull this all together. After looking at the details, the potential upsides, and the serious risks, what does this executive order really boil down to for you, the person saving for retirement? I mean, it really feels like a massive potential shift, possibly opening up that $12.5 trillion market to a whole new category of assets.
It really does set up this fundamental tension. On one side, you have the potential to maybe democratize access, give everyday investors a shot at high growth opportunities previously out of reach.
As this moves forward, it seems the big hurdles are pretty clear. We absolutely need better financial education for people with 401ks. We need regulations that are clear but also balanced. We need careful management of those fiduciary risks. We need real transparency. And we need to address those high costs.
Absolutely. The ultimate success or failure of this initiative, whether it actually helps or hurts the average investor, is going to depend entirely on how carefully those regulations are crafted and implemented.
It hinges on getting that investor education right and on whether the financial industry can responsibly manage the risks that definitely come with crypto and other alternatives.
And that really leaves us with a big